Every person starting his entrepreneurial journey wonders how to get his venture funded. To help you navigate through this complex topic, we have with us Dr. Anirudddha Malpani. He will be delivering a keynote on how to get an investor to fund you. Let me introduce you all to him. He is the founder and director of Malpani Ventures. They are an active angel investment firm investing in early age startups. Over the last few years, they have invested in more than 15 companies. The venture provides investment to diverse sectors of early age startups, including healthcare, financial technology, SaaS, consumer technology, and education technology. He is also a prolific writer who expresses his views on a wide range of topics, and he has also authored 4 books. So,
So should I just go ahead and start?
yes, sir.
Okay, guys, good morning. Why is everyone sitting at the back? Everyone here in your college seems to be a backbencher or what? Or the front seats are reserved only for VIPs and there are no VIPs around. What's happening? Okay, can you guys hear me? Hello, can you hear me? Okay, great.
Yes, sir.
So what I'm gonna do is, I'd have loved to be actually there in person because I think the energy and the vibe when you're actually in a room makes a world of a difference. And the trouble is, I can't make out who's sleeping in the audience and who's paying attention, which is a bit of a problem. Otherwise, when you're actually giving a live speech, if someone is sleeping, you can throw a chalk at them, right? Did your teacher ever do that to you in school? No, you were all good boys, so no one ever did that. Is that right? Okay, so here we go. All right, so let's start off. And, entrepreneurship is hot and everyone thinks, okay, now that I have this great business plan, I need to get hold of an investor to give me the money. And this is extremely common for people. And they think this is the standard process. So you read all this, you're going to IIT, you're learning all this exciting new stuff, whether it's on Twitter or LinkedIn. Elon Musk excites you and he said, yeah, we're young. The world is full of new opportunities. All these old fogies and dinosaurs don't understand anything. And we can definitely do a better job than everyone else. How many of you think you're Superman? Come on, guys. All of you should be thinking of yourself as, okay, maybe not Superman, maybe Wonder Woman. I can't make out how many women there are in the audience. And you feel, once we've got this great idea, we marry a great idea with an investor who gives us money. And he gives us a little bit of money and we will multiply it so it becomes lots of money so that I become rich and the investor becomes rich. So, what can possibly go wrong? And this is usually the way people think of how startup investing works. And I think the reason people think this is you reach too much what I call startup porn. And the reason I call it startup porn is because a lot of these press releases which you read about are actually paid for by the media. They're paid for by investors and VCs, which is obviously going to give you a very idea which is very skewed and distorted. And basically people feel, hey, I'm the bright guy. I have this bright plan. I create a brilliant plan. All I need to do is get hold of investor to give me the money. I make the product and we sell it and we'll all become rich. I wish that were true because, I come up with lots of bright plans and lots of ideas for this thing. And I wish I could then find someone. And I wish life was really that simple. But innovation, creativity is all far more complex than we actually think it is. And the standard response when you go to an investor is always going to be, no, sorry, that's not going to work, which can be very frustrating and disappointing and depressing because what's the point of going to IIT and doing all this studies and coming first in college and getting a rank if you can't get someone to give you money to actually implement your dreams? And I think this is part of the problem that we still have a lot of misconceptions about how the startup world actually works. And that's what I'm going to try to do, bust some of these myths for you. And this is always going to be the standard response because as investors, it's much easier for us to say no because every time we say yes, we have to start the due diligence. We have to look at your pitches. We have to talk to you, all of which takes time. And, let's be honest, you might think investors have nothing else to do except sign checks. But the reality is we're fairly busy and we need to help our existing entrepreneurs become more successful. So this is the easiest option for us. And then instead of becoming Superman, you actually start behaving like this little kid who's always complaining about how life is so unfair and investors don't reply to our emails and don't bother to get back to us and no one's willing to give us money. And I wish we lived in Silicon Valley instead of all these stupid Indian investors who really just want to be frugal and refuse to give us money. But my point is, this is actually a flawed model. And of course, you need money to implement something, but the money from VCs and investors should actually come fairly low on your list. So the important thing is you need to generate your own money. And if you can't generate your own money, why would you expect an investor to give you any? It's possible that perhaps we are richer than you are, we have more money than you do, but it's still hard-earned money. That doesn't mean that it's money which you're willing to throw away, which means, and especially you can start doing this even when you're in college. You can start freelancing, you can offer consultancy services, and the reality is there's lots of options today for intelligent engineers to be able to provide their skill sets, and people are happy to pay for this. So you can do this as a freelancer, you can do this as a part-time consultancy. There's absolutely nothing wrong with doing a job, and I encourage you at least spend a year. Your best job would obviously be working in a startup, preferably a stable one, because you can learn very quickly. But it doesn't matter where you choose to do it. You need to be able to learn how the corporate world functions. And while you're working, you will have a lot of spare time, because let's be honest, most jobs give you a lot of spare time if you're willing to do them diligently. You can utilize that in order to then create whatever you're doing as a part-time basis. The important thing is you need to learn to bootstrap, and that's still a very unfamiliar term, and I'll talk a little bit about that. But of course, there are more sources. You can raise money from family, you can raise money from friends. The best source of funding is customer funding, and this is something which anyone can do, and it's become so cheap and easy to actually start. You can easily create a product, you can do this digitally, you can market it digitally, and you can actually see if people are willing to buy. And if you can, trust me, that's going to give you so much confidence that you're on the right track. And if you can get customer funding, getting investor funding becomes so much easier. There are other options such as crowdfunding, and there are new options all the time, including what are called ICOs. The important thing is there is no shortage of money for the right person. Remember that. Don't come from a position of scarcity, come from a position of abundance. That if you come up with a product which customers are willing to give you money for, there's going to be no shortage of people who will give you more money so you can do a better job. I think this is important. And you need to remember there is a right time in your journey as a startup to raise money and whom to raise money from. So if you just have an idea or a concept, you need to bootstrap. You can't go to an angel and say, hey, this is my idea and give me the money. That's just not going to work, because angels have so many better options from other entrepreneurs who've got a mature product, who are generating revenue. Why would they give it to you? Once you cross the idea, you can then move on to, have you been able to create a team? And remember, we back the jockey. We don't just back the horse. And if you can't even convince your friends to join you as part of your team, then you actually need to worry, do I actually have a business or not? Once you've created a prototype, something tangible, then I think you can start reaching out to the world. If it's an academic project, you can get grants. If it's a little more, you can actually join an accelerator. And I'll talk a little bit about startup accelerators. Once you've actually launched, I think this is the right time to reach out to angels. There's no point in reaching out to an angel too early, because the chances of you getting a no are much higher, and that can be very depressing. So wait till it matures. There's really no rush. This is something which you want to do at least for a long period of time. So you don't have to think in terms of weeks. Once you've been able to launch, you've got some business backing, and you've shown that you can get users, and importantly, not just free users, people who are willing to give you money, which means they can actually see value in your product and you're generating revenue. I think then you can ask for more money. You've actually earned the right to ask for money from investors. And this could definitely come from venture capitalists as well as angel investors. Two very different animals, and I'll explain to you why they're different. And once you've reached the growth stage, you can then reach banks. And you might find it interesting I'm putting banks, but trust me, banks are the most inexpensive source of funding, because all they do is they charge you an interest rate. Whereas remember, investors are actually like Sherlock. We want a much bigger chunk. And the reason we want a much bigger chunk, the reason we demand a much bigger return on our investment, is because we're taking a much larger risk. Go to your bank manager with your business plan and see what he has to say. And I can guarantee he'll refuse to give you money because you don't have anything tangible. As investors, we help you to create something tangible so you have a cash flow. Once you have cash flow and you have profits, I think then banks will be much more willing to give you money. All I'm trying to tell you is this is a journey and there is a right time and the right place from whom to raise money from during your journey. Why is bootstrapping so important? A, it proves you can actually do stuff. Ideas are never enough. You've got to prove that you can implement, but much more importantly, it shows that you have faith in yourself. And if you're not willing to invest in yourself, why do you expect me to invest in you? And you don't need much money these days in order to actually create a product and sell it online. And you need to learn what is called guerrilla marketing. And all these are unfamiliar terms. In a way, that's great because the good thing is you can learn about all these concepts. Always remember, your customers are your best source of funding. Your customers will give you feedback, they're beta testers, they will help you improve your product, they will market for you, they're market evangelists, they're brand ambassadors, and the guest thing is they will do it for free because you're adding value to your life, to their life, and they will add value to yours. And honestly, if you can get paying customers, investors will come to you and say, hey, please take our money because they know that you're doing something valuable. And this was true even in the US. But you talk about VCs and angel investors for most businesses and startups, but the reality is most of the money comes from your personal savings or from family and friends, not from anyone else. And there are other options and it's helpful to explore them. There are lots of mistakes which people make when they are trying to take money from family and friends because it's so convenient. You can always arm twist your rich uncle, or perhaps your mother will give it to you, or perhaps your father-in-law if you've been smart and married a rich father-in-law. But the common mistakes are lots of people will do it because they love you and care for you, but they don't understand how risky startups are. There's a very high chance that you may not be able to return the money back. And then you've ruined your relationship with a family member. So that's risky. I think you also need to tell them that, hey, the money is not going to come back to them within a year. Most startups will take anywhere from 5 to 10 years to actually start generating revenue. And that's what illiquidity is. So don't oversell them because you'll end up creating false expectations. And that's a formula for unhappiness. And the last thing you want is an uncle saying, "Arey, ye to useless hai, baatein badi karta hai, paise khata hai, aur paise lautata nahi hai." Don't take money from people who can't afford to lose it because honestly, this is very likely that you will lose it. So if, for example, your father has a fixed deposit of 5 lakhs and you say, okay, we'll break the fixed deposit, give it to me, that's going to be something which is going to hurt him and hurt you. Taking the money as a loan, that's an option. But remember, loans need to be repaid. It can be increasingly hard to do that. And for heaven's sake, don't take money from an uncle who says, yeah, but I want 50% of your company for 5 lakhs. That's too high a valuation. And this is something which you will regret afterwards. So be very, very careful when you do some of this stuff. And honestly, taking money from people who haven't angel invested before just because their friends and family will come back to haunt both you and them, because it's often a bit like the lame leading the blind. And this is where I talk about ideas, implementation, and funding. Most ideas are bad, trust me. Don't fall in love with your ideas. And the secret for getting good ideas is to get lots of bad ideas. So generate lots of ideas. People are very worried. Oh, I want to sign an NDA or a non-disclosure. Or if I tell my idea to someone, the VC will then give it to his son-in-law and then he will implement it. Honestly, no one's interested in stealing your ideas. We get tons of ideas every single day. So please, in fact, share your ideas, ask for criticism because this is the right way to polish them. And remember, ideas are not enough. Passion is necessary because you're going to have to do this for a long, long time. So you need to be perseverant, but it's definitely not sufficient. And this is what most people think of an angel investor. Guy's got lots of money. And the reality is we have lots of money, but we've earned it the hard way too. So finding investors is simple, but it's not easy. And for every 100 investors you contact, 95 will just ignore you, which can be frustrating, but that's the way the world works. Multiple options. Most investors will have an email address. You can cold email, you can reach them out on LinkedIn, you can reach them out on Twitter. The best thing, of course, is to get a warm introduction. Get someone in your college, an alumnus or a professor who can then do the introduction, because then the chances that email will be responded to is much higher. But I think the secret is establish yourself as a thought leader. And it's become increasingly easy to do that. All you guys need your own websites. You all need your own social media platforms. This is such an easy thing to do. Share with the rest of the world. And if you can show someone, hey, I know a lot about EVs, I know a lot about batteries, I know a lot about machine learning. And not only do I know a lot about this, I'm happy to share it with the world. I'm articulate, I can communicate well, I can express well. And the way to do that is by creating a digital portfolio with your website. Investors will come to you because we're always looking for the right people to fund. Also remember, the purpose of the first email or the first meeting is very limited. No one's going to give you a check in the first meeting. All the purpose of the first meeting is to get permission to get a second meeting because it takes time. Remember, you can't just send emails to Sequoia and Matrix and everyone else just because you've read a press release about them. You've got to find people who share the same sweet spot you're in, the same risk reward. Are they early stage or late stage? The industry, do they understand anything about your industry? And preferably investors who invested in other startups at the same stage as you are. As I said, a warm contact, a warm mutual contact, a warm introduction is best. And it's fairly easy to find a lot of these warm introductions. But the important thing is please do your research. Don't mass email. Don't spam investors. Don't say, dear sir / madam. Please, if you're going to take the time and trouble to send an email, please customize the email. Don't be lazy. And if you want to be lazy, then don't complain if investors don't respond back to you. The amount of hard work and effort you put in will pay off. I can promise you that. Have realistic expectations from investors. We're busy people. We get flooded with pitches and it's much easier for us to say no. So it's important, be persistent and be patient, but please respect our time. We want to be helpful, we want to be responsive, but the most valuable resource we have is our time, and we guard our time jealously. Just because you're a student and you have a lot of spare time doesn't mean investors have a lot of spare time. I think startup accelerators can be very valuable. They teach you exactly all the stuff I'm telling you. They give you access to investors. And if you graduated from a good startup accelerator, you get this halo effect. But let me warn you, not all startup accelerators are good. Some are terrible. Some will charge you an arm and a leg and charge you a lot of money and provide no value. And then just talk the talk, but will actually end up sucking all the money away. And in fact, if some guys come to me from certain startup accelerators, for me, that's a red flag. I will never bother to fund them because I know they've started off on the wrong foot. Pitching is important, and it's fairly easy to create pitch decks. It's fairly easy to find all this information. You can read books, you can do a Udemy course, and basically start off with, I think, what the problem is and how you're solving the problem. And remember, if you're actually generating money, then that should be your first slide. Start off from your position of strength, so your investor wants to find out more about you. Lots of entrepreneurs will make a lot of these mistakes. So, for example, they'll ask for an NDA. An NDA is a non-disclosure agreement. Honestly, no one's going to sign an NDA if you're going to pitch to them. And if that's what you're going to ask for, it just proves that you don't know what you're talking about. You're a complete rookie, and we don't want to waste our time educating you. Then a lot of people will go to a chartered accountant for doing a valuation and do what is called a discounted cash flow. That is absolutely no way to value a company, because all discounted cash flows are works of imagination, because they all depend on your terminal value. And anyone can create an Excel spreadsheet and show how you grow 50% every year. That's all rubbish. Finally, when you discuss stuff with an investor, don't try to bluff. Please accept feedback and criticism. The very fact that we're engaging with you means we think that there is some potential in you. But if you think you have all the answers, it's very hard for us to do that. And of course, the commonest problem is everyone wants to be an entrepreneur. And we've had some guys I've got some guys who've been pitching me for the last 10 years, and they send the same deck and perhaps they add a new slide. But this guy's never going to leave the security of his job. He's just going to keep on dreaming. And then after 5 years, talk about, hey, I had the idea for Uber 5 years ago. So big deal. Could you implement something? Sure as that. Common mistakes, if you only come to us with an idea, no implementation, that's a red flag. It's very easy for us to say no. If you're going to show a hockey stick curve when you're showing revenue, we understand that you're dreaming, and most dreams become nightmares. If you ever tell me you have no competition, this tells me just one of two things. you being lazy and not bother to do your homework, or the reason you have no competition is because it's such a bad idea that no one else wants to do it. So that's really not very promising. If you don't bother to invest your own money, if you don't have any skin in the game, that's again a red flag. And if you use buzzwords like crypto, AI, blockchain, ML, without knowing anything about this stuff, that's a red flag too. And of course, when you come to us and we decide, okay, this is of interest, this is then when we actually start the one thing where we can add value to your life, what's called due diligence. And due diligence happens in various stages. There is a pre-negotiation, there is a checklist, we then have to negotiate and then finally offer you what we call a term sheet. And then perhaps if everything works well, a shareholder agreement. Don't worry too much if you don't understand what these words mean. I know I'm not going to be able to explain all this, but I'm going to give you more links and the link for a book which will help you learn more about this stuff. When we do our due diligence, we look at obviously what your market is. We look for things like total addressable market and stuff. We understand a lot of that is fiction, but we still do this because we want to understand how well you can explain this. We look at your business model. Most importantly, we look at the team. But remember, if you've actually got traction, if you're actually generating revenue, then we really don't care about anything else. And all we care about is your cash flow statement. And honestly, we don't care where you graduated from. None of that actually matters. So all these things about certificates and diplomas and I am an IIT grad may be okay for helping you walk into the door, but doesn't help you beyond the particular stage. For funding, remember everything is negotiable. Make an offer and don't get upset if someone refuses your offer. There are lots of things about pre-money valuation, how much you're willing to control, how much control you're willing to cede, and there are lots of these additional things which you need to be aware of. And this is something which you need to learn. It's perhaps something which is not very comfortable for you, but like everything else, it can be learned. And the good thing about being an IIT is that you get a chance to learn all these things. There's lots of information available. Our preferred option is different from other people's preferred option, and that's absolutely fine. Different people will do different things. Our preferred option is called compulsorily convertible preferred shares, and we give this in tranches and based on milestones. But this is what we prefer. Doesn't necessarily mean this is what you need to agree with. And of course, this can really be scary when someone sends you a term sheet because it's full of legalese, and you need to learn this legalese. Remember, if you want to be an entrepreneur, you can't say, I will do this and I will not do this. You pretty much have to do everything, including cleaning your office, making sure your website is up and running, doing your sales, doing your pitching. You need to understand what term sheets are, what shareholder agreements is, and you need to hire a lawyer because you can't outsource that to anyone else. Find a startup friendly lawyer. Just because your uncle happens to be a divorce lawyer doesn't mean he'll be the right startup lawyer. The important thing is use standard templates. A lot of these are available. So none of this is expensive. Shouldn't cost you much money. And focus on areas of agreement first. Because if you agree on 90% of the stuff, it's very easy to then find out what the areas of disagreement are and sort them out. The trouble with lawyers is always lawyers look for problems and they want to help you, in one sense, tell you how much difficulty there is. And that is not a startup friendly lawyer. A startup friendly lawyer is business friendly. He'll try to help you close the deal. I think this is important, what's called splitting equity in your startup. So obviously when you start, you have 100%, but you have 100% of a pie, which is worth nothing. In a way, this diagram is not very factually correct because the fact is that as your slice of the pie decreases, the size of the pie itself keeps on increasing because when you've got an accelerator, you may earn a little bit, you may own a little bit less, but because you've now got paying customers, the pie has become much larger. So at the end of it, even though you started up with 100%, you may end up with maybe 20%. But 20% of a $1 million company is still worth a lot. We now come to angel investors and VCs, and these are completely different. And I'm going to tell you what I am as an angel investor. So why do we invest? We don't have money to burn. And angel investors will do it for different reasons. Some of us will do it because it's our own benefit. We hope that we will make money. The reality is we don't. Some of us have retired and we, it's okay. It's fun to engage with young guys because it helps you feel young. They want to be involved in something interesting, something entrepreneurial, because otherwise it's very boring talking about how the world is going to the dogs and how the politicians are all terrible. And we want to be engaged in something which is new and exciting, because it keeps us new and exciting. And that's the reason I do it. Hanging out with young entrepreneurs energizes me. And obviously it gives you bragging rights when you say, yeah, I'm an angel investor. Some of us do it for the benefit of the world, and I'm a social impact investor. I want to do it because I think the education system is completely broken and we want to make a difference. And I think there's a huge opportunity to do that. And of course, some of us do it because we understand how difficult it was for us when we started our own business, and we want to help others so that they don't have to go through the same pain. Who are the kind of people I invest in? The first thing is you need to fall in love with the team. Now that sounds so intangible and so irrational, but the reality is we all make decisions based on irrational reasons and emotional reasons, and then we use logic to back up those irrational reasons. So it's usually non-financial. For me, I'm not saying I'm throwing my money away, but I'm definitely looking for a learning on investment, not just a return on investment. I'm looking for three things: integrity, because trust me, I've funded crooked entrepreneurs and they run away with all your money, and that leaves a terrible experience. Entrepreneurs who are curious, because if you're not curious, you're not going to be able to keep up with the world. And entrepreneurs who are humble, who understand that they don't have all the answers and are willing to learn from us. Basically, entrepreneurs who are willing to teach and willing to learn. Simple enough. But for me, if I can find an entrepreneur who has paying customers, that basically trumps everything else, because you've done all the rest of the stuff, and it's then much easier for me to give you money because you've sorted out your basic problems. You're not learning at my expense. You've already finished the learning at your expense. You can make much better use of the money I'm going to give you. There is a big difference between smart money and dumb money. Trust me, not all angel investors are the same. And today it's become very fashionable for everyone to call themselves an angel investor. But the first thing you need to ask them is, when did you sign your last check? And if you gave a check for 1 lakh 5 years ago, that's not the kind of angel investor you should be talking to. Do your homework before accepting the funding. And the most important thing you need to do is talk to the other startup founders this angel investor has funded. And if they don't have good things to say about him, honestly, don't take the money. And finally, please treat the money with respect. It's hard-earned money. And raising funds actually means you've taken on a lot of responsibility, because if you just blow up your own money, what, you just wasted a little bit of your time, maybe maybe a year or so, but you're young. That year will not be such a problem. You'll have learned in the process. But other people's money, please treat with respect. And that's what our ideal of an angel investor entrepreneur relationship is. It's a long-term relationship, and it's a long-term marriage. Some pearls of wisdom I'm going to share. Please beware of investors who ask you how much return you can give them, because this clearly shows that they don't know what you're talking about. And some of them can be very predatory and very entrepreneur unfriendly. And investors who don't respect your time, who give you an appointment and make you wait, or who tell you they'll do something and then don't do it, those are bad, because after giving money, they'll just make your life hell. The trick is, don't push your company, don't sell it to investors, get investors to come to you. And the best way to do that is to set up a competition. And the best way to set up a competition is to show them you're generating revenue. Because if you can tell an investor, hey, give me money because I need it, no one is going to give it to you. But if you tell them, give me money and I will double your money for you, trust me, you'll get a long line. And follow up with investors until they give you an answer. And it's fine if they give you a no, but ask why they rejected you, so at least you can improve your pitch for the next investor you pitch to. Please learn to negotiate. Don't be too rigid, but don't be too flexible, and don't bend over backwards because you're just desperate for the money, because they'll take advantage of you. Finally, remember, funding doesn't mean that you have a business. It just means that one investor believes in you and your business plan, but that means nothing. The only thing which means you have a business is repeat paying satisfied customers. All of these are important. Your customer, cheating a customer the first time, taking money the first time is not hard. We all know that. But paying customers are important. Free customers don't count, but they need to be satisfied, which is why I don't think Byju's is a good business at all. And more importantly, they need to be repeat paying satisfied customers. These are brand evangelists who will refer your company to their friends because you're adding value to their life. All these vanity metrics, downloads, number of time spent on the web, the amount of web traffic, these are all a trap. They don't mean anything. And always remember, ultimately, at the end of the day, you need to monetize. Until you can do that, you don't have a business. A no is not a personal rejection. Take a no as a not yet. You'll always get an opportunity to pitch again to the same investor and perhaps to pitch to other investors. Please don't get distracted with all these unicorns and these outliers and all these press releases which all these startup guys send because VCs fund them. They're just a distraction. And all these stories they're all myths. They're all flawed. They all cover up the failures. They all cover up the ugly truths. So don't get misled by them. And always remember, investors are optional. An investor can't do anything without an entrepreneur, but you can always bootstrap. There's a big difference in angels and VCs, as I said. We invest personal money. And we come in all shapes and sizes because angel investors are of different age. There are 30-year-old angel investors who have family money with deep pockets. There are older ones like me who use our personal income. We have different motivations. But the most important thing you ask them is, when did you sign your last check? Don't waste your money on guys. Because you know what? They'll ask you, sure, come and meet me. They'll spend an hour wasting your time. They'll make you pay for the coffee. And they'll energize you. Oh, wow, they'll name drop, they'll give you all kinds of, yeah, I know such and such, and I will do an introduction to Falana Dikana. Complete waste of time. None of this stuff works. What's the point of an introduction? That what you really require is a check. VCs are completely different. They have general partners, they have limited partners. But remember, a VC is a business just like your startup is. And the institutional imperative for the VCs, they need to return the money back to their limited partners. That's why they have to generate money. And they have a very limited time frame, which is why their interests are often not aligned with your interests. You need to be careful. And often the decision making by an angel investor is much faster if it's often done by a single person. By a VC, it's usually an investment committee and they take much longer. So this is what the sweet spot is as far as a VC is concerned. They need a huge market because they need to grow very, very rapidly. They need a business which can scale very quickly because they want you to gain a market share, and they obviously want you to have a much better product. Because ultimately, out of every 100 pitches a VC sees, they need to reject 99 because that, if you can see, that spot is really very, very short. And this is how a VC does things. And if you notice, they will start up with deal sourcing, hundreds of them, and they will reach out to you and send you emails, and you'll get flattered. Oh, wow, I got a VC from Sequoia Matrix. Doesn't mean anything. That's the job of that VC's junior analyst, to actually find deals, to source deals, as the technical word is. They then need to screen, they need their preliminary due diligence, and typically the junior analyst is not the decision maker. He then needs to send it to a partner who's then very hard to get hold of, who then has to send it to an investment committee, who then, if they agree, will then send a term sheet. All this takes anywhere from 3 to 6 months. You cannot force this. You cannot do it any faster. Then there is all the legal stuff and the negotiation and due diligence. So it can usually take anywhere from 6 to 9 months. Please remember that. Don't think, hey, I'm an IIT grad. I've got this great business plan. I go to this VC and he's going to give me the money. All these VC funding stories you read about is, oh, he pitched to me on the back of a napkin and he gave me the money because he fell in love. Only happens in textbooks and storybooks, not in real life. The bitter truth is that most startups will fail. The worst truth is no one knows which startup will fail, not even VCs know. And at the end of the day, that's why VCs fund so many startups, because ultimately it's a numbers game. It's called a power law. And they know that only 2 to 3% of their startups will give them outsized returns, but because they don't know which, they have to fund so many. And the ones which are doing well, they will keep on doubling up with. They have more than enough money to back those. But the ones which are doing badly, they're quite happy to allow them to die because it makes no sense for them to waste more good money after bad. Always remember, what goes up usually went down first. So don't worry if you encounter failure in the beginning. And all companies always need more money all the time. Lots of risks with being a startup entrepreneur. You need to be prepared for failure. You need to be resilient. But trust me, this can be such a great journey because whether you make money or not, I cannot predict. But you will learn a lot about yourself, your personality, your emotional resilience, your ability to lead people, your ability to sell, your ability to talk to customers, your ability to manage cash flow statements. All of these are valuable skills, and you'll learn a lot about the world. But it's a lonely journey, trust me. There's lots of emotional angst. very hard to convince your mother that you want to chuck up a safe job with Infosys because you want to do an entrepreneurship role. And it's very hard to find a father-in-law who will say, "Ha, mere beti se shaadi kar le, though you're an entrepreneur. Much safer to work for TCS." You need to find support, but other founders are the best source. And this is why online support groups and even accelerators can be so helpful. This is something I want to spend some time on. What are mentors and coaches? And just like everyone on LinkedIn calls themselves an angel investor, everyone on LinkedIn calls themselves a mentor. There's a big difference in mentors, consultants. Investors give you money. They may or may not provide you coaching and mentorship, and that depends on you and them. But the most important thing an investor can do is sign a check. Don't get confused. A consultant will charge you money and often is well worth the money if he has a lot of deep domain expertise and can open doors. But no good consultant will provide their services for free. The only worthwhile mentors are the ones who do it for free. Any mentor who charges you money is not a mentor. He can call himself a coach or a consultant, but don't get confused. Mentorship is done because he thinks he can add value to your life, but more importantly, he thinks you can add value to his life. There are incubators and accelerators, but the reality is there's so many parasites in the startup ecosystem. And these are crooked guys who actually prey on young entrepreneurs like you who have all these rosy dreams and starry-eyed dreams and don't know what to do next. And then they make all kinds of these promises, and the website is full of, "I have funded so many people," all of which is rubbish. And you'll never be able to find out the truth. But the reality is they will prey on you. They are predators. And they make money by preying on startup entrepreneurs who are clueless. So be careful. But I'd strongly encourage you set up an advisory board. An advisory board consists of experts, well-wishers, people who may or may not give you money. They may not have equity in your company, but who can provide valuable advice. And because they care for you, they will have your back. Remember, knowledge is always got a short half-life, but curiosity is much more important because you can keep on acquiring new knowledge. And that's why this is such an important board, that because learning has a short half-life, you need to always remember that you're going to be learning all the time. And I'm learning all the time, and that's fine. There's lots of stuff I don't know. And that's why life is so much fun, because there's so much to learn. The single most ingredient for success is learning. And the most important thing you need to learn is how to sell. If you can sell, everything in life will get sorted. You can always get a new job. You can always work for a new startup. But in order to sell, you need to tell stories. You need to learn to lead a team. You need to get your hands dirty. You need to be patient and persistent. And in the beginning, the best thing to do is to join either a stable startup, which is already being funded and has money, but is ready to take off and is grown. Because the great thing in a startup is there are always hundreds of things to do. And everyone is very happy if you're willing to do more than what your job description specifies. So it's a great learning platform. Lots of books. And don't worry, I'm going to share this presentation with your team. I'd strongly suggest please read at least 3 books. I just can't understand why people don't read more books. Books are cheap, they're easily available, and every book will give you a slightly different perspective. And sometimes books need to tell you the same thing 5 different times before it fits in your head. I'm a fairly slow learner, so I don't understand stuff the first book I read. Therefore, I read it a second time and a third time, and then it starts sinking. And don't get upset when you fail. All of us have failed. Trust me about this. It's only the approach you begin again. And if you do this, hopefully this is where you'll come up to. And this is my last slide. Even if you do nothing else at the end of this lecture, if you're serious about running a startup, please buy this book. It's called startupfunding.com. It's not an expensive book. And trust me, it will tell you so much which is so valuable so that you don't have to make your own mistakes. You can learn from other people's mistakes.